You are welcome to my channel. Today we are going to start a new topic. We are going to look at single entry and incomplete records. Now, we are in the accounting business. Remember, previously I told you that we have the double entry system. So ideally, in accounting, we are supposed to follow the double entry system. But that's not the case with very many businesses. So you find a business, for example, in downtown, they do not operate on a double entry system. These are people, for example, the vendors. So they don't find value as to why they should operate on a double entry system. For example, if they record, you find them, they have a small notebook. For example, if they pay for rent, you just find in their books, in that small notebook of theirs, they will only have rent. But they will not have the other account of the cash. So they will just show that rent was actually paid. So, meaning that they do not find value as to why they should continue with the double entry system. So there are very many reasons as to why these businesses do not keep or do not operate on a double entry system. So the reasons are, for example, they might lack resources. For example, they do not have quite enough resources to operate on a double entry system. And also, there's a limited of personnel. Let me say, they find it that they cannot get an accountant. So such businesses, their profits are always low, so they cannot get an accountant to come and operate or to come and run the transactions of the business. So there are very many reasons as to why that happens. Now, this is the danger. When it comes to single entry and incomplete records, as an accountant, you're supposed to prepare final accounts from those incomplete records. So, one, we need to find out how do we prepare the final accounts. When I talk about the final accounts, I'm talking about the income statement and the statement of financial position, which is the balance sheet. So today, I would like us to look at the estimations of profits using, when it comes to single entry and incomplete records. How do we estimate profits? One, I would like to tell you that we have quite about two. We have the net worth method, and we also have the conversion method. Now, when it comes to the net worth method, very many times, in fact, in certain books, you see that they are going to call the net worth method single entry, and they're going to call the conversion method incomplete records. But I would like to take it the same way, like the way it is, because even the conversion method, it is still single entry. So we are going to look at the net worth method. So let us start with our net worth method. I remember in the introduction of accounting, I talked about us finding the net worth of the owner of the business. I talked about something they call equity. So under equity, we compare the capital. So when we look at how much this person has in the capital, actually we can tell of the net worth of this person. So when it comes to the net worth method, here we are going to actually, remember, the information that I've given you, it's not enough for you to prepare final accounts. By the way, the information they give you determines which kind of method you're supposed to use. Remember, when we are preparing the final accounts, we said you must have the net sales, you must have the cost of sales, the expenses, and the incomes. But you're going to find out that the information that I've given you is not enough for you to prepare the final accounts. It means you are going to come up with a net worth method. Now, the net worth method is all about the comparisons of the capital. One is the opening capital and the closing capital. Let me give you an example. On 1st January 2023, you begin operating your business, let me say, with 20,000 shillings. You see? So, meaning this is actually our opening capital. So, by the time the year ends, let me say 31st December 2023, we actually check and we have 50,000 worth of capital. So this is what they call closing capital. Now, If this is what we started the business with, and at the end of the year we have this, in fact, we can ascertain the profit that we made during the year. It means we are going to get the closing capital minus the opening capital. Now, for this case, we shall have 50,000 minus 20,000, giving us 30. Now, this becomes our net profit for the year. Remember, these are businesses that do not operate on the double entry system. It means they do not even extract a trial balance. So you do not have adequate information for you to prepare the final account. So we are going to compare the capitals. One, which is the closing capital against the opening capital. Now, let me bring another twist here still. Now, we are saying that, for example, let's say his son, for example, this was a lady running a business, and she started the business with 20,000. Then at the end of the year, she has 50,000 as capital. Then information tells you, additional information, they tell you that his son gave him extra 10,000 as capital. Extra 10,000 as capital. So what are we going to do? Do we still have our 30,000 as profit? No, because that 10,000 that was put into the business was still capital. So it was like part of the opening capital. That means we shall subtract it off. That means what we shall do will be 50,000 minus the 20,000. Still, we deduct that 10,000, which is additional capital. That means our net profit for the year will be 20,000. So that's what we are going to look at now. I would like to take you through a format. This is just a sample, but I would like to take you through the format. So this is the format that we are going to use for determining profit. So we shall have our currency here. I'll put here Ugandan shillings, and as well here Ugandan shillings. So we are going to have, like I said, we are going to compare the net worth. So we shall begin with our closing capital. So we bring the value of our closing capital here. So we indicate it here. That's the value of our closing capital. Then there is something they call drawings. For example, if someone goes to the business and picks a given amount of money, for example, when they pick that amount of money, actually they are reducing their equity, they're reducing their capital. But if those drawings were still in the business, that means that amount of drawings that was taken out of the business would have actually increased on our profit. So it means that when those drawings are taken out, when this lady tells you that I took out drawings maybe worth of 1,000 or 2,000, those drawings are supposed to be added back, because we need to know actually how much profit was supposed to be made. So you come back here and say add drawings, we add them back. So you come and add them back here. Then we shall get a total. Now, we are going to subtract our opening capital. So what we are going to do is say less opening capital. So that opening capital, we bring it here, because we need to take an aggregate figure that we are going to subtract from the closing balance, from the closing capital. Then we shall also add additional capital. If there's any other capital that was introduced within the year, we add it back, then we subtract it off. So we shall say additional capital. So you add it here. Then you bring the total sum of the opening capital and the additional capital here. Then we are going to subtract it. So we put it in brackets to show that from our closing capital. And the value that we shall get down here will be our net profit. So this is how we are going to ascertain our profits using the net worth method. So is this very easy? It's very easy. So the challenge here is, and I would like to talk about this, they might not give you the closing capital and the opening capital. It means you are supposed to find it yourself. So the challenge here is, if you don't know how to establish the closing capital and the opening capital, it means you can never establish the profit. So what do we need now for us to establish the closing capital and the opening capital? So when it gets to that, it means we are supposed to prepare what they call the statement of affairs. What is the statement of affairs? The statement of affairs actually is the accounting equation. Now, it looks like this. Remember, we agreed that assets equals to liabilities plus owner's equity. Now, in this instance, owner's equity is the same as capital. So, what we are going to do, actually, we are going to have our assets minus our liabilities. We're going to bring this one this side, the liabilities this side, minus the liabilities, and they shall give us what? Capital. Then, if we have come to this, how are we going to get the opening capital? Here, we are going to get the assets at the beginning of the year. Then we subtract the liabilities at the beginning of the year. Then we shall get the opening capital. The same will apply to our closing capital. We shall get the assets at the closure of the year minus the liabilities at the closure of the year. Then we shall get our closing capital. Let me show you how it's done. Our statement of affairs. Statement of affairs as at, then you put the date. So if you're working for the opening capital, you put as 1st January, maybe any year I've given you. If it's at the closure of the year, 31st December, and the year I've given you. Any year I've given, that's what you put there. So, one, we shall begin with our, and of course we shall have here our Uganda shillings, cash, and here as well. So, we shall begin with our assets. So, let's say we are an organization, and at the beginning of the year, they had assets. Now, where are you going to get these values from? The ones that we are going to mention here, they always give you what they call a list of balances. Now, from the list of balances, they will tell you that at the start of the year, let us say 1st January, then they give you even 31st December. Let me say 2023. So, they give you a list of balances. So they tell you, for example, motor vehicle. At the beginning of the year, they give you, let me say 20. Then at the end of the year, let me say 15. You see? So they give you, so it's a list of balances. Now, from this list of balances, let me give you another one. For example, let us say stock. It was, let me say 10. Here, 5,000. Now, this list of balances, this is what you're going to take into the statement of affairs. Now, when it comes to the statement of affairs, for example, for us to establish the opening capital, what we are going to take, we shall only take the values or the items as at 1st January. Not at the end of the year. No, we are taking as at 1st January because we need to know how much did we start our operations with? How much do we start our business with? So we shall take the items in the list of balances under 1st January 2023. So we start off. So we shall have motor vehicle. We bring our value here. We shall have maybe equipment. Let me say, I'm just picking out a few. We bring our value here. Then, let's say we had only those two non-current assets. Then we bring in our current assets. Then let me talk about stock. We say we bring our value here. Let me talk about things like receivables, trade receivables. So our trade receivables. We bring our value here. We can also have cash. We bring our value here. Therefore, we shall have the total assets. But these ones, remember, like I told you, they are as at 1st January. These are the opening balances. This is what we start the business with, as at 1st January. Then, you come and say liabilities. Now, still, even the liabilities, we shall take the balances as at 1st January, the ones that we have started business with. So, we can say we have something like trade payables. Our trade payables, we bring them here. We can have something like, let me say loan. We bring it here. Let me take those. So we take the value. Then we are going to subtract our total assets from the total liabilities at the start of the year. Then what we shall get here is what we shall call our capital. Now, this is how we are going to ascertain for the opening capital and the closing capital. It is still the same criteria we are going to use, because all that we have to do is to first find out our assets at the start of the year for the sake of the opening capital. Then we subtract the liabilities at the start of the year. Then what we shall get here will be our opening capital. The same, we're going to use it for the closing capital. We shall have still the same items, still, but the values this time we are going to pick them from another column, which is for the closing balances. So, if it's motor vehicle, we shall not take the motor vehicle that we got at 1st January. No. For the example, for the purpose of closing capital, we shall take 31st December. That's what we shall use here. So basically, that's what we can do for us to come up with the opening capital and the closing capital. I think this is how we can do and find our net profit using the net worth method. Now, I would like us to take a question, an example. From this example, maybe your understanding will be enhanced. So the question says, Dickens runs a small retail shop for which proper accounting books are not kept. However, you have been able to ascertain the following. So they have given us a list of balances as at 1st January 2023 and as 31st December 2023. Now we have payables, 1st January 10,000, 31st December 8,000. Receivables, 1st January 20,000, 31st December 22,000. Inventories, 1st January 4,000, 31st December 6,000. We have cash, 1st January 6,000, 31st December we have 10,000. Then motor vehicle, it was 20,000, 1st January, 31st December it was 15,000. Then furniture was 4,000, 1st January, and then 3,000, 31st December. Then, additional information, they say, Dickens withdrew cash worth 2,000 during the year for personal use. Then the question says, required, prepare a statement of affairs as at 1st January 2023 and as at 31st December 2023. Then Roman number 2, statement of profit for the year. So that is our question that we are going to use. It is very, very simple. So we are going to, that told us to prepare the statement of affairs. So we come and say, Dickens statement of affairs as at 1st January 2023. So this is what we are going to take. Now, of course, we shall have our Ghanaian shillings here and our Ghanaian shillings currency here. So we shall begin with our assets. So when you check in the question, they have given us the assets that we have a motor vehicle. And now that motor vehicle, it was worth 20,000. So we bring the 20,000 here. So we go back to the question and see what's the next asset that we have. We have furniture. Furniture 1st January, it was 4,000. So we come and say furniture for. Now, the values I'm picking, because I'm now calculating for the opening what? Opening capital. The values I'm picking, they're only at 1st January 2023. I'm not picking the values at 31st December. No, because I'm looking to establish the opening capital. So our next asset we have is we have receivables, and they are worth 20,000. So we have receivables. They are worth 20,000. Then next we have inventories. So inventory at 1st January was 4,000. So we come here and say inventories. It is 4,000. So next we have cash, and cash was 6,000 1st January. So we have cash. It was worth 6,000. So do we have any other? No, we do not have any other. So when you get this total here, actually we are going to get 54,000 as our total assets at the beginning of the year. Then we are supposed to take off the liabilities at the start of the year. We take off the liabilities, and the liabilities we have payables, and the payables were worth 10,000. So we come here and say payables, what you call creditors, 10,000. I think we do not have any other, so we shall only take this. So we shall subtract it off, and then our opening capital will be 44,000. As easy as ABC. So this is what we have established. This is what we call our opening capital. Now remember, we have established the statement of affairs now at the start of the year. So now we're supposed to establish the statement of affairs at the end of the year. Then we shall find the closing capital. So when we get the closing capital, we shall put it and weigh it against our opening capital to see how much profit did we make. Now I'm going to rub off this, then I'm going to do the statement of affairs as at 31st December. So we start again. We shall find our assets. Now, we are going to get the balances or the items which are in the column of 31st December 2023. So we start. So as you can see, we have still our motor vehicle, and it's worth 15,000. That's what we have. Then we have furniture, and furniture was worth 3,000. Worth 3,000. Then we have receivables worth 22,000. So receivables 22,000. Then our next item is inventories, which was worth 6,000. So inventories 6,000. Then we have cash, and our closing balance for cash was 10,000. So we shall have cash, and we have 10,000. So when you check, I think those are the only values that we have. So when you add this, you are going to get 56,000 as our total assets. So you come here and say you less your liabilities. You less your liabilities, and liabilities that we have payables. and our payables were worth 8,000. So we subtract this off, and the value that we actually get will be 48,000. So 48,000 is our closing capital. We are there. So this is actually our closing capital. So if this is our closing capital, we are going to prepare now the statement of profit, because we need to establish how much was actually made as profit. So we are going to remember the other one, we got 44,000. Here we have 48,000 as closing capital. So we are going to prepare the statement of income, the statement of profit, for us to establish the actual profit that was made by Dickens. So what we do, so we come here and say statement, actually Dickens, statement of profit for the year ended 31st December 2023. So we shall have our Ugandan shillings here, our currency. So like I told you in our format that this is what we are going to follow. So we shall bring here our closing capital, which was worth 48,000. That's it. But remember, now, in the question, when you look closely, they tell you that Dickens withdrew cash worth 2,000 during the year for personal use. Now, remember, I told you that when they are drawings, we shall add them back to the closing capital, because if those drawings were not taken away from the business, actually it would have been part of the profit. So we come and say we add back the drawings, and now these drawings were worth 2,000, giving us a total of 50,000. So this is where we are now. So remember, what we are going to do now is we are going to subtract, you less the opening, the opening capital. Now, our opening capital, if you recall very well, was 44,000. Since there was no additional capital, we are going to take this. So, therefore, 50,000 minus 44,000, we shall get the 6,000 as our net profit. So, this is just it. So, we have established the net profit of a business using the net worth method. This is how it is. Very, very simple. Now, next I'm going to look at the conversion method. So we are done with our net worth method. So for now, let us end here, and then we shall continue with our video on the conversion method. So thank you so much for watching. This is Kevin Davis Accounting. Remember to subscribe, share to your friends, and also have a benefit.